Okay, welcome back everybody. I hope you found the last couple of hours really useful. Thank you for a super level of engagement. We're a little bit over time, so we're going to go straight into Q&A. Reminder to everybody, this is being recorded. So to the extent that you have to leave or dial off, you can obviously get the whole story later, but we would most welcome this last bit of engagement today. Look, we talked about how we're fundamentally transforming. We've talked about how we're differentiating ourselves in our strategic approach. We talked about the growing evidence of success. I'm going to be joined by Andy now. We have Kahina and Alex in the room. Shortly, the rest of the presenters will appear up here on the screen. We'll take questions online. You've got the instructions on how to do that, or Nilika can fill that in. Or obviously, we'll take questions in the room. So Andy, if you join me now, we'll dive right into Q&A, and we'll probably go until 12 o'clock or so. And we have the first question right here in Basingall Avenue on a sunny day in London. We've got a mic coming.
Thanks very much. It's Arman Rakkar from Barclays, so good morning first of all. I was just interested in, regarding the partnerships, if you could give us a sense of how the economics differs from offering through partnerships versus directly banking the clients yourself. Is this high ROE, fee income, low balance sheet business, or are you kind of giving away a decent chunk of the value by virtue of not owning the primary relationship? I mean, particularly, I think the example that you gave in Indonesia was quite interesting. If you're able to quantify any of that, yep, that'd be really helpful. So
I'll give Andy that question, and I'm going to ask Andy there were a number of questions that we picked up from the sessions we were listening in. I don't think we got everything, but we heard about it. And I suggested Andy try to bring a bit of that stuff together now. Andy?
Okay, right. So in the interest of time, this today was intended to be very much about sort of product client. It wasn't so much about numbers, but clearly the culmination of all of this is the endeavour to get the overall ROTE up to double digits. So ultimately, it does come back to the financials. I guess the way I'd look at this is over the last 4 or 5 years, we've invested a huge amount in sort of standardising and simplifying systems and processes within the business. We've now got much more consistency, which enables now to digitise and to put platforms in that will be ubiquitous, that will span product sets, that will be much more intelligible for customers, be easier for our staff, and a lot of what we're doing here is about that. Bill mentioned earlier the cash investment we've been making. We have gradually increased over the last few years. It's about $1.9 billion of cash in IT each year. The proportion of that is going into these more forward-looking strategic initiatives is progressively increasing. We think just over half of that 1.9 billion will be on these strategic initiatives going forward. If you go back on average over the last 5 years, it was probably about half that level. So there is an absolute focus upon investing into new platforms, into the new ventures. I'll come to partnerships in a minute. Secondly, separately, but in a way linked, we have been investing in selective equity stakes. About 200 million of those in pure equity stakes over the last 2 years, 2.5 years. We would expect that sort of run rate to go forwards. Those businesses are largely early stage investments, so we haven't crystallised, realised a lot of them, but a pretty conservative valuation of those would be roughly a doubling. That doesn't feature in our numbers at the moment because of the way it's accounted, but just wanted to get visibility on that. Expenses-wise, we will be investing more into the new venture areas, and the more they take off, the more we'll be doing that. We'll obviously need to look at the collective of the cash expenses for business to make sure that by investing in the new businesses, we're still leaving enough for the core businesses to go forwards. But a number of the initiatives we heard here will both be additive to the customer growth opportunity and efficient in terms of running the business. The cost of acquisition of new customers is fundamentally lower, for instance, in Africa today than it was 2 years ago. Branch closures, more digital, it's taken the cost per customer acquired down about 2/3. And in that period of time, the profitability, as we've gone through this evolution to digital, has actually increased in the retail business in the Africa, Middle East region. So this year's profit in retail will be higher than pre-COVID levels, despite the fact we've seen interest rate reductions during that period of time. So that sort of thing gives us the confidence, actually, that we are on the right track. Eventually, to come to your question on the partnerships, there will be different commercial arrangements with different partners, but generally speaking, it will be a small percentage of the income that would go to the referring partner. and then we will deal with all the economics behind it. So that typically either will be no upfront cost and a small slither of the taking goes to the other partner. Occasionally, we will do a pay upfront and then we'll take the full economics. But either way, the cost of acquisition will be much, much lower. And indeed, it has to be much, much lower, because if we're going to get a ×5 increase in the retail customer base, we have fundamentally got to acquire customers at a different price point to the ones that we have historically acquired. I think eventually I got to your question.
Yeah, thank you very much.
Thanks. It's Manus Costello from Autonomous. Bill, you talked about giving us more visibility on SC Ventures in 22, which is exciting. I wondered if you have thought about any more fundamental restructuring of the group to help realise value, because I know one of your peers in Asia, Siam Commercial Bank, had a pretty remarkable reaction when they reorganised the group. Is there anything more fundamental that you would consider down the line, given the scale of that ambition? I think you were talking about 50% of revenues coming from these ventures.
It's a good question. Obviously, we've seen what other people have done or are in the process of trying to do. What we're trying to do is build value in Standard Chartered. We don't believe, you may tell us that we're wrong, that we can create value or at least realize untapped value simply by moving the deck chairs around and changing the shareholder structure in some way. Now, that said, if there's a different ownership arrangement for something that we think liberates value, we're more than happy to do that. And that's exactly what we're doing in SC Ventures. So we own 65% of Mox, we own 60% of our venture in Singapore. We own 100% of Nexus, but as Andy mentioned, there's a referral payment that obviously based on success, that we're only making payments to the extent that there's income. We have a 5% stake in Tosbank in Korea or Line Bank. So we have many different ownership configurations that we think will maximize the value for us in each of those ventures. And we could easily see those ownership stakes changing. We could increase our stake in one, we could decrease in the other. The idea that somehow we package this up and take SC Ventures or some superset of ventures, including SC Ventures, package it up, sell it off, and hope that increases the value for the whole, I remain to be convinced that that's value creating. Now, if we do the work and we think that somehow that creates a different environment, a different culture, different partnering opportunities, different competitive dynamics versus the people we'd like to work with, yeah, we'll look at that. It's not our preoccupation right now. Our preoccupation right now is build great stuff that meets, that delivers against unmet customer needs, create value that way.
But we will pull out from next year the ventures activities and give them more visibility as a sort of entity in their own right. Now we can see where we go to thereafter, but we will give more visibility on them going forwards.
Thank you. It's Tom Rayner from Numis. On digitisation, I think the benefits for retail are fairly obvious, given the big numbers and the fact that you can increase scale quite effectively. I'm just wondering, with the corporate side, is that quite the same, because there's less customers with larger flows? I'm just interested in your thoughts around that. And also in the wealth management space, obviously these digital offerings are very attractive to the younger cohorts, but I'm assuming that most of the wealth is currently sitting with the older sort of parts of the population that might not be so open to digital offerings. So I'm wondering how that might affect how it progresses. Thank you.
So we'll bring Kahina up, and Kahina and Simon can take the first part of your question while they're getting up here. On the wealth side, as we talk about increasing the number of retail customers up to 5 million, obviously we would expect to keep on going from there. A meaningful proportion of the incremental income from our mass client base will come from wealth products. Right? It's quite small today. It's a growth opportunity from here. It's also the feedstock for our future premium, then priority, then eventually private banking client base. Where we're getting a high proportion of our new wealth clients, our new affluent clients in the bank, are coming from our mass population. Something like 2/3 today are people who are upgrading from that less wealthy categorization. So, but you're right, and Andy's point, if we have 5 million customers, they're going to be at a different price point, and we'll have to evolve that customer base into the wealth offering. But it's nothing but upside and opportunity for us, especially given the cost of acquisition for those clients, and just statistically, a very small percentage of 5 million can be quite impactful over a few years to our wealth business. But Kahina, you maybe start and then Simon can chime in.
Yeah, so as we talked about actually in our session, corporate and institutional in many ways has been seen as kind of the last vestige of digitalization versus retail, which has been going on for a couple of decades, just as an industry trend. But what is really interesting right now and why it's so exciting is that we are actually seeing our corporate clients and corporate and institutional clients kind of demanding technology because they are using data and digital in their businesses across industries. So you can see, just as we talked about APIs, why are APIs important? Well, APIs are important because that's allowing us direct connectivity with our corporate clients. We are seeing demands, you saw the numbers, over 200 million and growing transactions through APIs. You couldn't even imagine that 2 years ago. And now we're at a point where, whether it's Nigeria or Hong Kong, clients are saying, connect with me via APIs, show me all of my accounts via dashboards, let me get real-time connectivity so I can make real-time decisions. And I actually think that there's tremendous value to be unlocked on the corporate side because of the size of the flows, the sophistication of the clients, and leveraging data and real-time connectivity. Simon, did you want to add anything?
No, yeah, the only thing I'd add, Keenan, you've obviously covered most of it. I'm in the middle of what's my first business trip of 2021, which is very exciting. And I think every single client meeting that I have had has had two consistent themes. One has been sustainability, but the other has been digitization. And as we now start to pitch for business, the clients are asking us less about what's your product expertise. They're asking us much more about what is your plan for digital rollout. And that is what the real lever for the wholesale bank is in terms of digitization.
But Tom, we have a meaningful market share in the corporate business today. It's a very fragmented market. We have tremendous opportunities for share growth. And we also have tremendous opportunities to grow the number of clients that we deal with, most obviously on the smaller and SME side, but also in multinational corporations where we pick up more and more of their business. So the EVA impact of these investments on the corporate side are every bit as exciting, if not more so, than the EVA opportunity on the retail side. Roll, Alex. Why don't you stand up, Alex? Just stand up so the camera can see.
I was going to just add one last point, which is corporate clients are a major origination channel for new ideas, new ventures. Engagement leads into workshops, can lead into JVs and new venture initiatives. So it's a major interaction for us.
Great. Why don't you hand the mic back to Raul? Oh, you got it. Good.
Hi, it's Raul from JP Morgan. I guess a broader question about capital allocation. There's a lot on your plate right now. You've got a very strong capital ratio as a bank. You obviously got a very, very big investment budget now into these strategic initiatives versus where you were. But we can point to a number of different banks, which are your competitors, which have got bigger budgets. So the question really is, how do you decide that $1 billion is the right number? And if you look at your plate, you've got your marginal dollar that could go into buying back your stock, buying the assets of a competitor that's exiting some of your markets, or putting it into a new venture that somebody came up with an idea for, which might be worth a lot. So what is the highest priority for you as a management team?
Yeah, so the priority for this portfolio that we're talking about today is very straightforward. First in class, best in class, scalable fast, disruptive with purpose. That's it. That's what we've been doing. I can tell you that the returns, we believe, on that portfolio are superior to the other options that we see in the market right now. Now, obviously, there are other things that are coming up from time to time. We'll adjust regularly. But if we can satisfy those three criteria, and by the way, there's only a few things out of the millions of opportunities that meet first in class, best in class, fast scaling, and disruptive with purpose. Those are the ones that we go for. They're leveraging our core strengths. Everything else is going to go to somebody else. And if there's other opportunities for capital allocation, always looking at share buybacks, especially at the share price, as a benchmark, the things that we're investing in are far superior to buying back our own shares, in our opinion. And if you see any transactions from Standard Chartered in the weeks or months to come, it would also be far superior to buying back our own share. Otherwise, we'll buy back our shares.
Hi there, it's Andrew Coombs from Citi. I guess I'll just stay on the same theme. You've talked about the three key points in terms of investment, as you said. So I guess trying to link those three themes in with the financial aspect. You have the aspiration on the cost income and the ROTE in a medium term. When you look at your investments where you take a majority holding, are there specific financial targets for those investments? So is it a case of you need to break even by year X, you need to generate a cost capital return by year Y? Or are you thinking about it much more holistically in terms of there might be second order benefits to the rest of our franchise in these regions?
We're looking at it more holistically, and we're also looking at it at least with a substantial, if not complete, lens of the way the market is looking at these investments. So to the extent that we're building something that is preferred by customers to their existing mode of dealing in a particular set of products or dealing with a particular set of products, problems, if we believe that we can deliver something that's differentiated, we believe that we can generate value from that, although it's not always crystal clear on day one where that's going to come from. The amount of capital that we've invested so far is actually quite limited. The success that we've seen off that capital that we've invested so far is a lot. We've had a lot of success. That gives us a lot of confidence in knowing how to target incremental investment, but also how to build on what we've already got. Now, do we have an eye to where fintechs are trading in the market? Sure. Do we think that that's the valuation that we're using for our calculation? Absolutely not. Absolutely not. We've got a good old-fashioned financial model that ultimately gets to EBITDA and discounted cash flows that we think is going to generate value. Have any of our ventures gone exactly according to the original financial plan? Absolutely not. I mean, let's just start with the fact that interest rates went to zero and people traveling from Hong Kong went from everybody a lot to nobody at all. The only person that's used their Mox card for a cross-border transaction is me. And that's only because I can get into Hong Kong with limited quarantine. But that's obviously going to change. And when we can tap into that million-person trip.com partner that we've got, I mean, how exciting is that? Yeah, but it's definitely setting the financials back 2 years. Does that deter us from investing in great products? No. Did we pivot completely from travel product to credit product? Yes, we did. First credit card in the market, single card, one click, debit to credit, super exciting, completely differentiated, and seamless. Right? So yeah, we're creating value. It does not show up in the P&L yet.
I guess just staying on this, it's going to be a trickier part of the question, but you've given us some great examples of some real success stories today. But can you give us an example of something where you did invest and actually, after a couple of years, you decided, actually, we don't see a way forward here, and you pulled the investment?
Yeah, so the number of things that we killed after a couple of years is 0, because nothing lived that long. But Alex, give your 3 greatest failures.
There's a lot more than 3, really. So we tend to discontinue things quite early. The method we follow is specifically not one of building something and hoping they come later, having invested a lot up front. The method we follow is a lot nimbler, which consists in having a prototype, testing it, iterating it, testing it again, iterating again. And we like to think that the better ventures are the ones that have iterated the most, as opposed to the best original idea. So we only really invest once we know we're onto something and that something's going to scale. On the back of which, a lot of things never see the light of the day. And sometimes it's the idea, sometimes it's the team, sometimes it's the product market fit. It can be a lot of different reasons why it doesn't see the light of the day, but the vast majority of ventures will never exist. The ones we're talking about today are the ones we think can scale.
Any write-offs in the investment portfolio?
Sorry?
Any write-offs in the investment portfolio?
No. Okay. Small.
Aggregate amount of the 600 that we've invested that is on the cutting room floor?
Sorry.
We've invested $600 million life to date in ventures broadly defined. What's the percentage of that that's been left on the cutting room floor?
Cutting room floor?
I know he's French.
Okay.
Which way? I'm asking how many dollars have we spent, how many of those 600 have we spent money on but then didn't carry on with?
By definition of the 600 million, they're the ones we've carried on with. We start very small. So meaning
it's single digit millions.
So it's single digit.
It's low single digit millions.
The idea is a very small outlay in the beginning, and then as we know we're onto something, as we know a platform's going to scale, then start investing and then invest materially on the successful ones.
So it's absolutely the right question. What are the what's it costing us to generate these successes? And so far, the answer is very little. And maybe we've gone a little bit slow. And maybe we've left some great ideas behind because we've discontinued or underemphasized some things that could have been great. Maybe. But we're quite happy with the portfolio that we've got. All right, I know we're running tight. So we had a couple of other questions. And if we have any questions coming in online, you'll...
Hi, thank you. Can I ask about the client growth target, please? Do you have the portfolio of ventures today that you need to deliver the 5x number? And is there any more color that you can potentially give us around, is it more about banking as a service or digital banking? And just give a few numbers around that. That would be great. Thank you.
Yeah, we have the portfolio today. Clearly, that portfolio needs to be extended into new markets. So as we take Mox and roll it out into Singapore, as we take Nexus and roll it out into Kenya, and 2 or 3 or 4 other markets from there. As we grow Assembly Currency Fair, which is a high volume transaction with very high touch points, as we continue to accelerate the product offering in the African digital banks. So all of the pieces are there. There will be new pieces as well. But for sure there will be new pieces as well. But to get to 5 million, we just need to grow the existing business at the pace that we're growing it today. But rolling out in new markets, that's going to take both operating expense, so that $200 million that we spent last year is going to grow, and that will require incremental capital. Why are we talking about all this? Because want you to know what we're spending your money on, and obviously want to get your feedback on whether you think this is what we should be prioritizing. Part of that is understanding whether we can generate value. So yes, we have the portfolio today, but it requires significant ongoing investment.
Bill will now take a question from the virtual audience. It's from the line of Ed Third from KBW. If we look across the wider fintech space, the number of new entrants have won tens and millions of customers despite having none of the competitive advantages that you alluded to in terms of brand licenses, etc. Why do you think this is, and how might that change going forward?
Look, I think everybody's picked their niche, and there's some stunningly fantastic fintech companies out there that have addressed unmet customer needs. They've been highly reactive. They probably flew underneath the regulatory radar screen for some time, and then they get swept into the regulatory environment, sometimes in a low-touch way, sometimes in a very impactful way, as we're seeing, for example, in China, but only after tremendous value has been created. So I take nothing away from the fintech competitors. In fact, many of those are our partners. I mean, those are exactly the systems that we're plugging into. But is there anything that prevents us from being as agile, as deliberate in terms of addressing or identifying and addressing unmet customer needs? No, there's nothing that prevents that. Do banks typically have the culture that is so customer obsessed and so focused that banks are going to take over the fintech world? I don't think so. I don't think so. I don't think banks generally have the culture, the focus, or the regulatory latitude. But is Standard Chartered different? Our proposition is yes. Why are we different? Because we have no choice, right? We had no choice 5 years ago, and we have no choice today. I'm really happy with the choices that we've made. I think we've got a good track record of success. I don't know that we'll be the most agile and the most innovative organization in the world, but we're pretty good. And you combine that with the comparative advantages that we've got, and we can win this game. That's our proposition. Yeah.
Hi, Ian Gordon, Investec. Just in terms of the journey to a sub 60% cost income ratio, how do you conceptually think about it? Clearly you're generating additional cost headroom for the new strategy. Clearly you expect scale to deliver revenue uplift quickly. So are you asking the market to swallow any meaningful J curve, or do you aspire to generate a pay as you go?
Well, we are today in the high 60%. And in part, that is because interest rates have depressed the top line. But that is a fact. So I think going forwards, we'll have 2 or 3 things play out. One is rates over time picking up, and everybody will have their own views on it, but that might be not immediate, but sort of later. Secondly, next year, we should have the benefit that the top line is unfettered by rates holding us back, which has been the case this year, and therefore the true volume growth in the business should be more visible. And thirdly, progressively, the sorts of things we're talking about today should cut in. So I think there is a momentum that is building rather than this being, from the 1st of December, it'll all be, clicking into place. We are very focused on the costs. We're very happy with the current year cost guidance. We have said repeatedly today that we want to get the balance right between investing enough expense to get these new areas to grow, but not stifling the core business of what it needs to also get the growth in there. And that's something which we are giving thought to at the moment. So a simple answer to your question, I don't think it's going to be entirely linear. I think a number of these will build. But I think if you put all of those together, and indeed you do the maths on our 10% royalty, you pretty much, depending upon your exact assumption set, have to get to around that number for everything else to lock in place.
If I could just be a little bit specific in a couple of cases, and some of this came up in the Q&A in the rooms. The Nexus as a business model, once fully scaled, will have an extremely low cost income ratio, right? Because you've got very low cost to acquire, and you mentioned the small referral payments, extremely low cost to serve, and entirely 100% ownership of the residual income. So that's a very low cost income model. So at the outset, like today, that's not benefiting our cost income ratio at all. In fact, it's having a negative impact because we're spending money on it. As we get to full scale, it dramatically reduces the cost-income ratio for our Indonesian retail business, and obviously, as we roll that out for the rest of the bank. The African digital banks, where we're closer to full scale today, right? We're close to the same number of customers in the African digital banks as we are for the rest of our African business. Extremely low cost-income ratio, right? Cost to acquire, very low. Cost to serve, as Sunil mentioned, cost to acquire 1/3 of a conventional branch-based account. The cost to serve, 1/3 of the existing cost to serve. We're reducing branches along the way because those branches are no longer required by our customers. So that's further reducing the cost base of the business as a whole. That's driving the cost-income ratio for that business well below 60%. That's going to play out as Mox gets fully scaled, as our Singapore Phoenix operation gets fully scaled, much lower cost-income ratios. We are not going to offset that with much higher credit losses. Right? Now, there may be slightly higher credit losses. There's no question when you're going at a different price point with a credit-led strategy or a credit-embedded strategy, we'll have more LI, much more than offset by the income improvement that we're getting. That's our bet, right? And obviously we'll see if we're right. But it's something that I think we'll all be watching a lot as things like buy now, pay later become the fad of the moment.
We'll take one final question. We have massively overrun, so. Any
more
final
questions
question?
in the room? We'll take a question.
Oh, excellent.
You said in the last 5 to 6 years, you've already spent a lot of time sorting out the legacy system. And so just how much is there left to do in terms of that? And obviously 50% on innovative spend is a very, very good number. But I think most of the fintechs or challenger banks are probably on 70%. Is that something that you would aim for?
Yeah.
That's one. And the second one is, do you see a time when cost to service customers in the UK or some of your more entrenched markets could be reduced by 2/3, similar to the scale that you've seen in the African market as well? And what sort of time frame are you thinking that might be achievable? Because if I look at a scale, that's probably about, a typical cost to service a current account is probably about 150 for an incumbent bank in the UK, for a Monzo and Starling probably 50. So that's sort of the difference we're thinking. So just wondering how you see that.
Thankfully, like some of my old friends, we're not planning on attacking the UK retail market anytime soon. But good luck. The core banking systems are now rolled out in 2 of our 3 largest markets. So this is a cloud-based, it's a proprietary application. All the migrations have happened smoothly so far. The big ones left are Korea and Hong Kong. We've left those for last, and that'll come in 2023 for 2 reasons. One is they're big, and 2 is they're on completely different core banking systems today, whereas the other migrations were more evolutions within the core. So as we get out to 2023, we'll be fully migrated to cloud-based, unified core banking system. That means when Kahina rolls out a new set of products for the CCIB client base, we only have to test it once. We don't have to test it 17 different times, which is what we had to do last year. 17 core banking systems, 17 testing protocols, 17 opportunities to screw up the migration and upset customers, right? So that directly affects the speed of delivery on the corporate side. Also on the retail side, we are in the final stages of developing our 3rd generation mobile banking app. Footnote, Generation 1 and Generation 2 are best in class. They were best in class when launched, continue to be recognized as leading, not best in class anymore, but leading. Generation 3, we benchmarked against the existing mobile banking apps in the market. It's best in class, not number 2, best in class. Now, by the time we get out there, other people will have innovated. We'll see if we're still best in class. We will also be evolving our capabilities. So back end will be largely sorted this year. The remainder will be sorted over the next 18 months. The front end of retail, continuous improvement, but in very, very good shape, I think, for a first-in-class, best-in-class experience for customers. The stuff in the middle is mixed. So we still have meaningful proportions of manual intervention. We still have a population of employees that's long operational services people, typically on lower wages, and short automation at every point along the way. So when you hear some of the stats of 85% straight through or 70% straight through in core CCIB products, et cetera, those are the successes. There's more that we can do, much more that we can do, which is why we're comfortable. Leave aside the increases in expenses that we're talking about in SC Ventures just for a moment, which we're going to be very transparent about and we'll be talking about, which is why we've been able to keep our expenses flat for 5 years, 6 years, while significantly increasing our investment and growing our income consistently over the past several years. It's because we do have plenty of productivity opportunities left. So we don't want you to think that we're sitting here with this perfectly oiled machine today, no opportunities for productivity from here. That's not the case. What we do have is a track record of delivering on those productivity commitments, delivering the end-to-end process, delivering the better and improving customer experience, and obviously having that drive our income growth, drive the cost-income ratio down, and get us to the 10% plus ROTE. So exactly the right question. Work in progress, encouraged so far. But you guys have been really, really super engaged. Thank you for that. Thanks for coming. Thanks for coming here in person, if you made it here in person. And if you didn't, I hope you had a wonderful virtual experience on your nth video conference of the last 18 months. I look forward to seeing you in person going forward. And obviously, as always, the IR team, Andy, the rest of the team are all happy to keep on engaging, answering questions, and committing to more transparency. So thank you.